Home equity loan, or Gear Up, is a special type of loan that property investor can make use to leverage on banks' money. Today we will explore the method of using this, so that property investment can be done with little, or sometimes no money from investors' pocket. What is exactly home equity loan? A home equity loan is a type of loan in which the borrower uses the equity of his or her home as collateral. The loan amount is determined by the value of the property, and the value of the property is determined by an appraiser from the lending institution or bank. The special thing about home equity loan is that you can do it multiple times. For example, if you have bought the first house, over the years, chances are either you have paid partially or fully for it. The house value may have increased too. So, when you talk to the bank, they may give you money as part of the house valuation. It is called Gear Up from the first house. Using this Gear Up money, you can pay the down payment for the second investment house, generally about 10 to 20% purchase price. The rest will be paid by mortgage loan. After a while, especially if you can buy the second house at a below market value, you can apply for revaluation, and then get the Gear Up money out of the second house also, and then use it for the third house purchase, and so on. From the concept, don't you find it a fantastic strategy in property investment? Using home equity loan, you can unlock the value from your exiting property and use it to create more value. The bank money given out of home equity is used as deposit for new property purchase. This makes little or no money down investment possible, as you do not have to come out with a lot of additional cash for new investment. The wonderful thing is that you can use it multiple times, hence can multiply your investment fast. Let us go through the method step by step. Firstly, try to buy your first undervalued property, using what you have. It can be a whole big topic by itself on how to buy an undervalued property. For the purpose of using this strategy, we will go through briefly. To buy undervalued property, you need to know the value of property in your target area. Know what the market price per square feet, or square meter is. Generally, the local property website or newspaper will have this information updated regularly. If not, you need to do a tabulation of the transaction price, and figure out what the fair market price is. Once knowing what the fair price is, you will now be able to find which properties currently offered is undervalued or selling below market price. Do take note of those cases like urgent sale, must sell, divorced, bank sale, undervalue, etc. It is a high chance that you can bargain for a good price in those cases. Sometimes, the undervalued property is not surfaced on the advertisement or property website, as they can be transacted fast. Property agents are the one who knows about it first, as the owner contacted them. So instead of trying very hard to find such cases, you can ask the property agents to contact you. Just be specific on what you want, and be nice to the agents. They are your friends, and will help to make your property investment much easier. Be ready to buy when the good opportunity comes. Good buys will disappear fast. So be ready with your bank loan and down payment money. Do your calculation carefully. Always be ready to make an offer, and give the deposit if the offer is accepted by the seller. Negotiation is also very important. Be nice and polite but firm on your offer. After doing the calculation, stick with what you think is a good price. Target for at least 20 to 30% below market value. The more buffer you have, the higher chance of you to make profit, and get more home equity loan out of it. Be patient. Do not be afraid of giving an unusually low offer. You can offer and keep quiet and wait for a while. The seller, if really want to sell, may just come back to you. It might not be the final purchase price, but it is set stage for the negotiation to end at a low agreeable price. If not, be ready to walk away. You can always come back to make another offer, if the deal is truly a great one. Just remember, a good property can turn bad investment, if the price is not right. After the first step of buying a good undervalued property, the second step is to revalue the property at a higher valuation, so that you can take out as much equity loan as possible. As an investment property, it is better to rent out the property at high rental. You can make use of the strategy of subdividing the property to get high rental income. Especially commercial property, the value is much dependent on the rental. You can also make some improvements in your property to make it higher in value. This can be new coat of paint, new gate or door, an additional room, a new pantry area, etc. something that is visible to the valuer, so that they can add value onto the property while doing assessment. When engage a professional property valuer, do tell him or her what good about your property. This will score additional point, hence higher value. Do target for at least 20 to 30% increase in valuation, as you will get at least 20 to 30% the property value out of it as an equity loan. Once having a significant increase in property value, you can start shopping around for the equity loan. Check with several banks, to see which one give you the highest valuation, and better offer in term of interest rate and loan tenure and so on. For investment purpose, try to stretch the mortgage quantum to the maximum possible amount, and to the longest possible loan tenure, or payback period. In that way, you will likely be able to scale up your investment faster, and even have buffer for the downside. After getting the best possible gear-up loan, the next step is to use it as deposit for your next investment property. Sometimes, due to restriction of the amount of loan a single person can borrow, you can set up a company to invest in gear-up. An operational company is more favorable to the banks when it comes to borrowing money. They perceive operation company as a better person, who has regular cash flow to pay back the mortgage. We can advise individual on how to set up an operation company, using the methods in this course, so that bank will be happy to loan you more money. Let us go through an example of how it can be done in real life. Andrew is a 46-year-old engineer. He had a saving of around $100,000. After studying the market carefully, Andrew bought an investment property for $468,000. The rental income from the property is $2,700 per month. The bank loan installment is $1,600. After subtracting some other cost and expenses, Andrew has a positive cash flow of around $800 per month. After 2 years, Andrew was able to refinance the property at $560,000 valuation, and get $75,000 in cash as equity loan. Together with the rental income over 2 years, which is about $19,000 in total, Andrew now has around $94,000 to invest into a new property, without adding any single cent of his own money. This is a real-life example of a good deal that makes home equity loan a good strategy for little or no money down. This also applies to commercial property. A few things to note in this method. Firstly, as any other type of property loan, this is highly leveraging tool. It can be a great tool to scale up your investment fast. However, you need to take care of the downside too. Be sure your rental income from each property can cover the bank installment. It is advisable to have some buffer by doing a stress test, which is to assume the bank interest rate can go up higher than the current rate by 1, 2 or 3%. Work it out so that in the worst scenario, you still will be able to service the bank installment every month. After profiting from the investment property, do have a plan for deleveraging. After a while, when your property value goes up and your cash flow is in a good shape, you can sell 1 or 2 property and pay off the debt. This is the deleveraging process, and will give you peace of mind in the long term.